Okay, let's answer some questions from Sunday's Market Outlook. Two big themes this week. One is agency, and the other one is Bill Ackman. So, at least I saw a couple questions about that. I've been looking at long-term strips as a duration play. However, I stumbled across principal only and interest only. Could you elaborate the difference a bit? Size. Interest-only strips will have a smaller outstanding size, which means they'll have far less liquidity, but a higher yield if you can get them. It's not uncommon for an interest-only strip to have maybe, at market value, being that they're trading for under 30%, 28 27, 28 cents on the dollar. It was not uncommon that you could buy the whole outstanding issue for 2 million or 2.5 million, probably owned. So there wouldn't be much liquidity, and even if you could get in, you might not be able to get out. I tried modeling the price with rate cuts to 3% yield, but I just can't seem to get the 2.6 of the current value of the 2048 strip, as you mentioned on your previous Q&A. My calculation shows 75% price increase from 27 to 47.5. I don't have my calculator with me, so I can't do the calculation. So I'll pass on the arithmetic. What is your stance towards agency? It seemed to have a pretty ugly drop in tangible book value per share. However, non-GAAP EPS of 65 doesn't seem too bad, according to preliminary results. I'm underwater, but only took a third of a position, so I could dollar cost average. I still believe that this drop is due to current market volatility and rising yields. Well, they're talking about their tangible book value per share dropped. I think it was $1.31. Where is it? Here it is. Let me bring it onto the screen. Let's just have a look. I know it's small writing. Let me see if I can make it any bigger here. There it is. Okay, I got it. Let's see. September 30th, tangible net book value was estimated to be 808 per share of common stock. Comprehensive loss was 102 per common share. And that's going to be unrealized losses because their balance sheet is financial assets, so they're reported at fair value. This is the important one here. Net spread and dollar roll income was estimated to be 65 cents per common share for the quarter. And out of that 65, that's they pay 36 cents in dividends. So, if you look at their dividend payout ratio as a proportion of their net spread and dollar roll income, you're a little over 50% payout ratio, excluding 5 cents per common share of estimated catch-up premium amortization. Total investment portfolio is approximately $59.3 billion, includes 2.4 to be announced agency MBS, 1.1 billion of credit risk transfer. Risk leverage, so leverage is 7.9, so it has increased from the previous quarter. I think it was down like low sevens at 7.9. Return on common equity negative 10.1%. Let's see, common stock estimated 131 decrease in tangible net book value. There it is there. 3.6 billion of cash and unencumbered agency MBS is approximately 52% of the company's tangible equity. Of cash and encumbered agency MBS. Now it's grouped together. I don't know how much is cash and how much is agency. This is something that probably helped a lot. Hedge portfolio covered approximately 116% of the company's funding liabilities. So they're overhedged. If their funding liability costs drop, this kind of would hurt them. They'd want to be underhedged there, but they're overhedged. Its duration gap was approximately 0.2 years, which is what they try to do, right? They try to hedge out duration risk so that interest rate risk is not a problem. They try to hedge out the interest rate risk on their funding, and they try to hedge out the interest rate risk on their MBS. So changes in interest rates shouldn't hurt them. It's changes in the spread between the MBS and the 10-year Treasury, and they're levered 7.9 times that spread. And over the quarter, each week in the market outlook, we talk about the spread. It almost hit a record. The record spread was like 300 and some odd basis points, and it was pushing up against 300 basis points for a while. Well, it's that spread widening is going to hurt them 7.9 times more than it should, because that's your leverage, 7.9x. They're basically telling you here, look, we've got our funding liabilities hedged out, more than hedged out, and our duration gap is very, very low. We've pretty much got that hedged out. Very small duration exposure, but it's the spread. And again, it is unrealized losses, because you have to mark that to market. If the spread settles down and starts to contract, it will benefit agency 7.9 times as much as it contracts. So these are government guaranteed securities, so I'm not worried about the asset quality. The asset quality is quite strong. If we're going to be worried about anything with agency, we have to be worried about the spread between MBS, agency-backed MBS, and the 10-year widening even more, which they're both government guaranteed. It doesn't make a lot of sense for that spread to widen. Why would the MBS, the agency MBS, be any riskier than the 10-year Treasury when you have the U.S. government standing behind both of them? It's the same issuer, right? So I don't like the spread, but the mortgage market is at the lowest level it's been in a long time. It's going to have a lot of sentiment built into it, and there is the recency effect, right? So everybody remembers 2007, 2008, the subprime crisis, when it fell apart. MBS was the worst place to be. It was full of toxic shit. Well, we have that effect as well. So as far as what I would do now, I can't buy anything because I'm in the process of moving securities across a border. I think I would have a hard time not buying at this point. But let me be very clear here. I can afford to lose, and I can afford for this to go down even more. I can afford it, but I would be comfortable with it. Because I think the Fed is done. I think that the next move is, if there is a move, the next move will be down and not up. I think Bank of Canada tomorrow is done. And we just needed the Treasury market to settle down. A lot of volatility in the Treasury market. Now, I'm not thinking MBS is going to recover anytime soon, but I don't think the dividend is at risk. Not with 65 cents per common share of net spread and dollar roll income, which is going to be cash, closest to cash-based income with a 36-cent dividend. So, answered a whole bunch there on that one. Let's move this back off the screen now. Okay. Your take on the impact of widespread mortgage rate buy-downs as resets happen into a potential recession next year. Could this strategy backfire on housing demand? I don't know why these two would matter. Like why you're drawing a line from one to the next. Don't you think that with rising unemployment, well, we don't have that yet. Maybe you want to say, don't you think that the potential of rising unemployment, property owners relying on rentals might face cash flow challenges, potentially leading to a surge in home sales for sale at discount prices? You can always make the story, right? You can always say as unemployment rises, this is going to happen and this would happen. You can always draw the line. But whenever you have a path diagram, and in more statistical terms, you know what a regression is, right? A regression is you have some output based on some input. whatever number of inputs you are. Let's say that you have 3 inputs, but you might have another set of inputs that forecast this variable, and you might have 3 inputs that together forecast this variable, and 2 that forecast this, and this one here may have 3 variables that input this one. That's called a path diagram. If what you're arguing here is a path diagram, right? So your output variable here, home sales at discounted prices. So you're probably looking at the house price index going down, and one of them would be supply, right? And your variable for supply, you're suggesting you're going to model that with unemployment, with investor, the correlation between employment and how many people are employed that rely on the rental income to pay, whatever variables you have. So these are paths. Well, there's going to be uncertainty here, which leads to more uncertainty here. The longer your path, the more uncertainty you have, and you're drawing out the hypotheses. But for these, you sort of have to think about it as probabilities. What is the probability that unemployment would rise enough that those who were laid off, which tend to be lower waged workers, less skilled workers, what's the probability that they own rental properties? It would be more likely that they would be the tenants and not the owners of the property. But with a tight rental market, especially in Canada, and all real estate is regional, so I can't speak to every city that you're in. Somebody may say, oh no, there's lots of apartments available here. Well, that could be a regional thing, but on a national level, there's still tightness in residential real estate in terms of rental residential real estate. So the probabilities of it are low. The path itself, I don't know that I would put a lot of weight on that pathway. So no, I think if you were going to see a lot of discounted prices, the interest rate would have done it. The interest rate would have made the cost of capital much higher than cap rates would justify. And that would have led to financial decisions, especially big institutional owners, to sell their properties. The rise in interest rates would have done it. The rise in unemployment, you'd have to make the case that it would be more concentrated in the people who owned rental properties that would then have to sell to afford it. But if they have a tenant, they don't need to sell, right? We could have a live in-person seminar with you in Toronto before you move. Maybe a live market outlook or another topic. Never thought of that. I imagine so. I have some hats I got to get rid of. Would love to have an in-person instruction with you and meet like-minded people there. Well, if we can think about a good topic, I don't want to show up to a group of people who are smarter than me and have them question me live in public about something I have to say I don't know. But if we can have a topic where I feel that I could add value, then yeah, sure. When I say that, I'm not that familiar with the Canadian market, which seems odd because I'm Canadian, but I'm just not that familiar with the Canadian market. So to present something about the Canadian market, which I'm sure that people in Toronto would be more interested in the Canadian market, or something about the Canadian market, that is not my area of expertise at all. A first-year analyst on Bay Street will know more about the Canadian market than I would. Do you think elevated loss ratios across the insurance industry could be assisting with capital market rates rising? Higher loss ratios suppresses insurers' buying power in the bond market. They wouldn't want to sell a bond at a loss to pick up a higher yield. Well, this is your if you're talking about the loss ratios, you're probably talking about P&C, property and casualty. and not life. So property and casualty usually has very short-term holdings. The majority of their holdings are in cash, because most of their policies are 1 year. Property and casualty, they're usually 1 year policies. So I sell you a policy for $1,000, and I get to keep that $1,000 if you have no claim. Well, I mean, less of course commissions and all that kind of stuff. I may have to pay out in that year, so I have a contingent liability. I'm not about to add duration when I have a contingent liability. Only after I know that I haven't had to pay you out can I then move that to my growth portfolio, as opposed to the operational portfolio that you hold, which is usually money market funds. So I don't know that it would. Well, I guess it would affect the long term in the sense that you'd have less to move to your growth portfolio. Wouldn't want to sell a bond at a loss to pick up a higher. Wouldn't want to sell a bond at a loss to pick up a higher yield. Well, you wouldn't sell a bond at a loss to pick up a higher yield because you're holding a bond with a higher yield. You just paid more for it. That's all. I mean, you can't fix your yield, but selling at a loss to rebuy the same bond to say, aha, I got a higher yield. You do have a higher yield. It's just that you're underwater on the capital cost, but that bond at that point in time is yielding more. Or is the insurance market not as impactful in the bond market as I think? Big in the money market, the 10-year and the 30-year. The 20 sometimes. The 20 is an odd tenor. There's not a big clientele for it. I'd probably say that with the increase in yield that you can pick up on the 20, probably some activity there, but mostly on very long term, because, and it's insurance, right? They usually just buy and hold. Comment on agency's big drop. Already did that. What are your thoughts on pursuing a managerial MBA at an Ivy League for someone who is done with the CFA program, already working in asset management? 4 years experience. Is it worth the tuition and cost? It depends. If you are unpromotable without an MBA, if you're unpromotable to a management position, if the organization you have says, look, we can't justify promoting you or paying you more without more qualification, there are some organizations that do that. At least the car companies do that, which is in Ontario. Executive MBA is a big thing for individuals working for the auto companies, because you get to a certain point where they do say you are unpromotable without an MBA. So it's offered primarily for them, and I taught at the executive MBA level, and you primarily have auto people in the room. Are you in that situation where your pathway to the top requires you to have one to be promotable? If it doesn't, why bother? I guess the other question I would ask is, have you topped out where you are? In other words, are you are you a good performer that your organization recognizes, and there is a pathway for you to move higher? Or is it sort of recognized that this is pretty much where you're going to stay? And if it is, then the only way for you to go higher is to jump to another firm. I don't know that I would give up the real world to go back to a classroom. I would have a hard time doing that. And if my upward mobility required me to have an MBA, I'd be looking at the executive MBA program, which does not require me to give up my job. It just requires me to give up weekends for a while. Do you have any videos specifically centered in bonds? I already answered that. Yeah, the last week entry for the portfolio construction series was about using treasuries to replicate TLT by calculating the basis point value of a certain portfolio size of TLT, and then finding bonds and getting the same basis point value, showing that you don't have to buy any specific bond. You just have to size your position to get the same basis point value, and you can replicate the factor exposure of TLT at a higher yield. What do you think would be the most positively convex hedge against raising yields on the long end of the curve? Well, short a coupon bond would be, I mean, if you're trying to hedge against raising yields, you want something that pays off if yields go up. That would be short bonds. But coupon paying bonds, you want lots of dispersion in the cash flows. High duration, lots of dispersion. I have a few duration sensitive positions I'm happy with, so I don't want to lower my deltas. Instead, I'd rather buy some protection. Why? I mean, why buy protection? If your holding period is 3 months, 6 months, then buy protection. But if your holding period is 2-3 years, why buy protection? Don't try to manage the day-to-day NAV of your portfolio. If you have a holding period of 3 years on something, who cares what it's going to be in 2 weeks, right? You only care about where it's going to be in 3 years. So the short-term pathway shouldn't bother you. So I guess my first question is well, what's your holding period? And if it's a longer term holding period, then why do you want to get involved in this, in hedging? Usually you want to hedge when you have a short term position, and you don't want to risk any capital loss. Then you'll hedge out. But beyond that, I don't know that, when you say duration sensitive, I don't know what those are either. And if you're happy with them, then just sit on them. Convex hedge, the biggest convexity that you can get are with options, because options have payoffs. A long call option has a payoff that looks like this, right? So there's your convexity. So if you want convexity, you can buy puts. They have convexity, or short another bond, I guess. But I think we're at the top of the rate hiking cycle. So I don't know that, other than the long end of the curve, bear steepening or bull flattening, other than it doing that, that's hard to predict. That's just hard to predict. So I don't know that I'd get involved in that. Insight on agency. Already did that. Defensive stocks. Utilities. Utilities had a nice day. Utilities got beaten up for a while, but they're coming back. Telecom. Banks are down a lot in the past 6 months. Dividend yields are 5 to 10. KRE is, I think, $38. It would be hard not to buy it under 35. KRE, I think I'd be interested in selling puts there if I can't wait for January when I'm back in the game. Then I could do these things, but I gotta, you gotta move to the sideline. Short-term pain for long-term gain, right? Uncertain time. Are people just moving them into gold and treasuries? I don't know where they're going, to be honest with you. And I don't know that there's a collective agreement on what's going on. I think you have camps, and I think you have equal sized camps out there that are fighting each other. That one day my camp is winning, the next day your camp is winning, and the next day my camp is winning, and if I don't like that, wait a couple days, your camp will be winning. It's just back and forth. So I don't know that there is this agreement. When we say, are people just doing this? I think you have to think in terms of different camps of people out there. And perhaps it's a larger demographic trend where that age group is just drawing down their assets to meet spending needs. There is that going on, yeah. There is the retirement group, which are in distribution mode. So yeah, that's going on. Then again, why would they want to get rid of high dividend paying stocks at this time? Well, high dividends paying stocks are low price stocks. Canadian REITs were high dividend stocks for a while. I got out of that a while back, but I look at the prices today and I'm so happy I got out of it. Most of them have dropped, 30, 40, 50% from where I got out, some 60, 70%. High yield doesn't necessarily mean they're great. Anything that starts pushing 13, 14, 15%, you have to look at it. I think a good high yield, rather than looking at the dividend yield of stocks as being, I'm in a high yielding stock, look at the free cash flow yield of the stock. So figure out what the free cash flow yield is per share and buy high yielding free cash flow stocks. That's energy. By a country mile, it is energy. So that seems to be the place to be. Exposure to ASML without committing my full capital for the shares. Could you walk through how you would think about strike and expiry selection for a long call? This is a European stock. It's in the Netherlands. I'm not sure if it has... does it have a U.S. presence? ASML. Let's find out. NV. What is it trading on here? NASDAQ. Okay, well, there's a NASDAQ. 675. Where are the options here? Let's have a look at the options. $5 strikes. Yeah, you could do options, but again, options, you're going to have negative carry because if you create a synthetic, so there's the price of ASML, and if you go out a year, it's the 50 delta is centered around the forward price, not the current price. So that means your 50 delta strike is going to be 1 year, whatever 1 year SOFR is, whatever the rate is for 1 year. That's the rate that you're going to pay. That's going to be embedded into the price of the call and the put. The put will be lower, the call will be higher priced. As interest rates go up, the price of calls increase, the price of puts decrease. So doing a synthetic gives you have negative carry. So here you have negative carry. Call it about 5.5% negative carry. So if ASML pays a 5.5% dividend, well, then you can cancel those out and you'll get some capital appreciation. But then again, the dividend is going to be in the put and the call anyway, so scratch that. That's not going to help you. I would seem to think you want to preserve your capital, then figure out a dollar amount and just buy as many shares as you can for the dollar amount. Because if you use options, you still have mark to market. This thing, it hasn't reported earnings yet, but when it reports earnings, if it's EUV, which is the big thing it's pushing right now, the extreme ultraviolet lithography, if the order book for this comes in light, then ASML could drop because this is big profit right now. I think I could use leap duration to capture upside on the next 1 to 2 years of 3 nanometer transition progress. I believe this is a good use case for a long call in my situation. I would consider, if you're thinking about this, I would consider on this one a risk reversal. In other words, you're going to buy an upside call. It's at 600. Buy a 700 upside call and sell a put below. Use a risk reversal. If you're right and this starts increasing, the delta on this rises. The delta on this falls, which means your total delta will increase as the stock rises. So I would consider a risk reversal on that one. When I say the delta rises at an increasing rate, the delta drops at a decreasing rate. So your net delta will increase. If I had to do it, I would do it using a risk reversal. I think I'd feel a lot better with that as opposed to a synthetic. Implication for U.S. Treasuries and interest rates if the petrodollar erodes. Probably less volatility. I consider it unlikely that we end up with a petro yuan. I agree. More likely scenario in my mind is that the U.S. ceases to be the global unit of account for energy. If the U.S.'s relative power and prestige in the world continues to fade, China, now the largest trading counterparty with Saudi Arabia, MBS seem far more amiable with Xi Jinping than Joe Biden and other U.S. officials in public settings. I think why they can get along, why China and Saudi Arabia can get along, is that they don't show up in each other's country poking their bony little finger in their chest telling them that how to behave and how to treat their people. Each one of them says, you do what's right for you, I do what's right for me, and we stay out of each other's business. So I think they get along that way because neither one of them walks into the other country with their hypocritical nose held in the air saying we don't like the way you treat people. I say hypocritical because, no country is without sin. And I think that the U.S. could probably benefit from a lot of that, is to say, you do you and we'll do us, as opposed to, the way they wag their finger in people's faces sometimes. I can imagine the petrodollar comprising, say, 60-70% of global oil transactions instead of all of them. So here's the thing with the U.S. dollar. I don't know that we can look at it in terms of relationships between leaders, between ideologies, between any of that. If you look at it in the cold light of finance, you need a big currency, a liquid currency, and a currency that every central bank has. That's the U.S. dollar. So it's not a question of I don't like America, I don't want to do business in U.S. dollars. It's I like finance, I like low-cost transactions, I need to do business in U.S. dollars, right? I need energy, I need a place to keep my money that's liquid and safe. Well, that's U.S. Treasuries. I need to conduct business, and most of the world conducts international trade in U.S. dollars, so I'm going to need it. So it's not a question of ideology here, who am I going to vote for? It's just a question of convenience and cost and access. That's why the U.S. dollar is what it is. The U.S. dollar is the basic de facto currency of Panama. Prices in Costa Rica are quoted in both U.S. dollars and colones, and then for the most part, U.S. dollars tends to dominate. The U.S. dollar is a de facto currency in so many countries. It would be difficult to see moving away from it. Now, that doesn't mean it can't be done. Just it's going to introduce risks and costs that will be above what you would get with the U.S. dollar. Is it possible you're exhibiting gambler's fallacy with the statement that the least probable things have happened this year and implying that the least probable Yeah, I'm just saying, the universe this year has decided to bend me over the car and have its way with me here because, looking back at when you think about probabilities, you look, at empirical probabilities, meaning, well, how many times did this happen in the past? And if you find that it, out of 43 times it happened once, you'd place a low probability on it. Well, guess what? It's been the year of low probability events actually just showing up. So if you were looking for a black swan event, it would be a string of low probability events all happening in a row. So if something has a 2% probability empirically, and another thing has a 3% probability empirically, and another thing has a 4% probability empirically, for all three of those things to show up, you'd multiply them, you'd have almost an infinitesimally small probability, and well, there we are. So, yeah, it's a behavioral, it's a behavioral thing that I'm employing. It's like, betting on heads and you get 7 tails in a row, and I flip it again saying it'll be tails, just because. I'm not going to win. You get to that learned helplessness where you think, well, what does it matter what I do? Nothing has worked out this year. on the macro level. On the micro level, it has. And I'm thankful for that. I will end the year with capital gains. So I will owe the Canadian government a final tax bill before I leave. But macro has been brutally difficult to play this year. 46-48, U.S. had a great deal of inflation. Yes, post-World War II had a great deal of inflation, you're right, which was very conveniently reduced the real value of debt the government owed. Yes, it did. I believe this is referred to as financial repression. Well, if you use a particular person's definition of it, do you think markets are pricing in this possibility? It would be nice if that were the case. I mean, you would hate for a period of inflation to not be used to its strongest benefit, which is to deflate away the debt. But we had governments on both sides of the North American border here that decided to have a race with inflation and say, we will not allow inflation to deflate away the debt. We're going to add to the debt at a rate faster than inflation. We'll show them. They're not going to deflate away our debt. Haha, see, we won. Well, I mean, that's it kind of feels what's going on is this race to say, no, we will not let inflation devalue the debt or deflate the debt, which is exactly what you want it to do, for God's sake. You use inflation to your advantage. Both the Liberal Socialist government in Canada and the Liberal Socialist leaning Biden government in the U.S. completely wasted this opportunity to deal with debt by using the very monster that showed up. Instead, they fed the monster, right? I believe this is, do you think markets are pricing this possibility? And what odds would you place on this happening in the future, given the current debt situation and trajectory of the U.S.? It's hard to forecast the U.S. Other countries become easier to forecast when their debt gets to certain levels. You begin to call it unsustainable. But for the U.S., it's far more difficult to get that done, only because the U.S. has capital, has lots and lots of capital. I think it has less than 5% of the world's population, but has more than 50% of the world's capital, all in one place. With that much capital, it's going to create gains and innovation and growth. The question is, can the U.S. elect politicians that grow the debt slower than the economy grows? And if they can, you can grow your way out of the debt, or at least out of what looks like a bad debt situation. So there's a couple of assumptions in there. Number one is that voters will begin to vote responsible people in. I don't see that happening. I think they'll continue to vote their colors. Social media and the traditional media will keep people divided because that's where the money is. The money is in keeping people angry and keeping them divided. Facebook knows this, and Twitter knows this, and Fox News and CNN, they know this. Keep your camp angry at the other side and they'll keep watching you. Tell them what they want to hear. Lie to people who want to be lied to. So I don't think we can count on the citizenry coming to their senses and electing popular people. I think they'll vote their colors. Will politicians move to the center? Nope, they will not. Not if the vote is in telling your people how bad the other side is and keeping them angry, because that's how you get reelected. So democracy is broken. Democracy is extremely, extremely broken. So do I think that this can get worse? Yeah, I do, which is one of the reasons why I feel absolutely comfortable with my decision to leave Canada, because I don't know that this gets better. And if it doesn't get better, because U.S. has all this capital and Canada has significant capital too, North America has a big capital base, because it may not get better, left-leaning governments tend to tax capital more than they tax labor, which means those who have it are going to have to pay the lion's share of the profligateness of our politicians. Well, not me. I'm leaving and I'm taking my puck and my net with me. There's a nice northern reference for some of you. You may recognize what that means. I believe the problem with EVs is demand and growth is not organic, rather being pushed politically. Well, yeah, a lot of it is. That's what incentives do, right? If you want people to adopt a certain behavior, you pay them to adopt that behavior. So if you want them to buy something that they normally wouldn't buy, you offer a $7,500 tax credit. You make it more affordable for them, and you make all the other taxpayers pay for that. That is what you do to try to get adoption of it, right? Those who do not already have one do not really want one. Yeah, I think there's probably a large group of buyers who are on that side that say, I don't really want one. And I wanted one till I did the research on it for a couple of videos I did. And after I got through the process, I thought, I don't want one. I really don't want one now. I have no idea where the nearest charging station to me would be out here in West Texas. Yeah. Have you been following XLU this year? I have. What do you think would explain the recent drop in it? The rising long-term rates. Utilities are regulated, so they have a guaranteed rate of return, which is a regulated rate of return. So they're very bond-like in their cash flow. And because they're very bond-like, they'll price out like bonds. But what I think what's being missed is the increase in asset value that utilities are going to have over the next 5 to 10 years as they transition the grid to greener energy, wind and solar. All of those assets get added to their balance sheet, and their rate of return is calculated on those assets. So if they can increase their assets at a fast rate, they can increase their earnings at that fast rate. As long as the Public Utility Commission says, yes, you can increase your assets 8% a year for the next 10 years, and we're good with that, then their earnings automatically increase 8% a year. Well, I shouldn't say automatically, but for the most part would increase 8% a year. And they are great dividend increasers over time. So yeah, the rising rates are pretty much what beat them up. Going in next year, I'm thinking of being long XEU, XLP, and some short high beta SA software as service names that are trading 10 to 15 sales. So long XLU, XLP, yeah, I can see that. But you want to short some high beta names, that's fine. You go right ahead and short them. I would not short dollar for dollar. I'd try to be beta neutral, which means if you are long 10,000 in XLU, you might only be able to be short 2,000 in the other name only because of the difference in the betas. But be careful shorting these kind of companies. They're highly volatile. Just watch a video in the applied series on the yen carry trade. Okay, I've already answered this. This was about do I have to pay... not do I have to pay, but do I have this right? I pay interest on the short position. Yes, you do. Why does the market assign a different implied volatility of the call versus the puts at the same strike level? They don't. I don't think that's correct. At the same strike level, well, you may be seeing just, depends. I guess it would depend on the option chain you're looking at and the liquidity in the option chain. If you have an illiquid option chain, and you're looking at really out of the money, let's say deep in the money calls, which would be really out of the money puts. The out of the money puts would mathematically have a higher implied volatility only because they're not worth 5 cents or 10 cents. They're not even worth that. They're worth a penny, but some options you can't price it at a penny. the minimum bid is 5 cents, and that would be too ridiculous. So I would have to know more about what you're looking at, and when you say the same strike, what's the spread between the bid and the ask? Are you looking at something super liquid that is very near the strike? You shouldn't see a difference. Given current economic, geopolitical, and interest rate, what are your thoughts of adding gold? I know nothing about gold. I don't get gold. I never, ever thought of adding gold to anything at all. I think if I wanted to add gold, I would add a gold miner that had a cash flow and good reserves. I would add a gold miner, but I wouldn't add gold. Now, the gold miner will give me less volatility on the downside, but as the price went up, because the gold miner's costs wouldn't change, gross margins would be sensitive to the price of gold. Not gross margin, but gross profit would be sensitive to the price of gold. It would just trickle down to the bottom line. I'd probably own a gold miner and not gold itself. But I'm not big on gold. I shouldn't say I'm not big. I have no interest in gold. I've never had an interest in gold. What are your thoughts on Canadian banks at a high level? Some are sitting on the highest dividend yet we've seen in a while. Price to book ratio is about 1. Proven track record of increasing dividends. Haven't cut them in many years. Haven't cut them in over 100 years. Some 150 years. The Canadian banks have had all the big five. Have had a history of paying dividends for well over 100 years. Not during the Great Depression, not during the financial crisis did they cut the dividend ever. So you're right on that. It's not just many years, it's decades. Over a century, if you want to put it in perspective. If one were to play the probabilities of the dividend were to not be cut, I think that's a very high probability that it would not be cut. It looks like interest value, along with future capital appreciation. Understanding is that earnings are growing despite increasing loan loss reserves. The risk seems to be that we are more interest rate sensitive and can due to the nature of the mortgage industry, right? And also the household debt levels. Therefore, if something breaks, they should experience further downside. If you had a 10% annual hurdle rate, TFSA room and 20-year term, 20, okay, well, yeah, then buy the banks. I mean, you got 20-year horizon, buy the banks. There's just a general lack of competition in the Canadian market with a population that's growing. Buy the banks. I absolutely agree. If you're not concerned about where the price is going to be in 3 months, but concerned about where it's going to be in 20 years and the return you're going to get, buy the banks and reinvest the dividend. Join their drip, and you'll get paid in shares, and then you never have to worry about it. Yes, buy the banks. I just want to see if someone with your experience sees other looming red flags in the near term for the specific industry. No. The banks have a different type of attitude. In the U.S., you can originate and sell. So if you're holding mortgages, you can always sell them. You can securitize your loans. You can securitize your mortgages. We don't really have that in Canada because of these 5-year mortgages. Well, they're 25 years, 5-year fixed on a 25-year amortization, but then you got to go back every 5 years and renew. So because of that, it limits the possibility of a good MBS market. So because banks have to hold it on their books, they're a lot more cautious about who they lend to. Yes, they still take losses. Yes, there are still concerns. But if somebody defaults on a mortgage, the bank takes the house back. The bank doesn't lose the mortgage, doesn't lose everything. It takes the house back and it sells the house. It may lose something on it, but the vast majority of that money is good. It's in a property. You would need massive defaults across the country to hurt the banks and potentially put the dividend into question. No, I would have no problem buying the banks if I had a 20-year term horizon and I didn't care and I was just going to reinvest the dividend and just forget about it. I'm in. What are some great websites and journals that you recommend reading regularly to keep track of markets? Well, Wall Street Journal is good. I don't know. In my news feed from the broker, I get a lot of stuff that comes through. So it's a matter of just looking at different headlines. I don't know that there's one in particular that stands out. There's a lot. For a lot of good information, for every company you follow, you can go to the website, you can register your email, and every time there's a press release or anything, they automatically send it to your inbox. So if you follow enough companies, all that stuff just shows up in your inbox. The moment it hits their website, it shows up in your inbox. Same with all the industry associations. Copper has an industry association, oil has a big industry, all of them have industry associations. Making their landing page, the news section of their landing page, a regular visit, you'll see the last 10, 15 news articles that have shown up. I mean, maybe you're not interested in certain things, right? Same with the Federal Reserve System. Visiting each of them and looking at their news, or having a notification whenever there's new stuff that comes out. You can create your own news feed in your inbox, and then once you say I'm not interested in this anymore, you hit unsubscribe. But in your broker's news feed, you can't unsubscribe. You'll still keep getting stuff you're not interested in. You got to scroll past a whole bunch of stuff you may not be interested in to find interesting headlines. There's National Association of Real Estate Investment Trust, the National Association of Real Estate, the Real Estate Association, the the Home Builders Association. I mean, there's just Google whatever you're looking for. There's always an industry association that has a news feed. Selling pressure hypotheses, longer maturity bond is due in part to higher energy prices. Wouldn't you think the sellers are likely to take a large hit on their balance sheet? Doesn't matter. You got a bill to pay. You need something. You need U.S. dollars, right? Either you sell your currency to buy U.S. dollars, or you sell your treasury. Now, in your domestic currency, you may not be losing anything, because the value of the U.S. dollar is up. Yes, the price of the bond is down, but the value of the U.S. dollar is up. So when you convert it back to your domestic currency, you might find that you have more of your domestic currency than you originally paid to get it, because of the strength of the U.S. dollar. So it's not just the price. When you're thinking about foreign assets, it's the combination of the price and the change in the currency value. So a loss could turn into a gain if the currency worked out for you. Now, if you looked at Monday, energy prices were down $2 a barrel on oil, and treasuries were up big time. Going into Monday night, the price of oil rebounded 50, 60 cents. Treasuries were selling off. The next day, price of oil was down. Treasuries were up. There's something there. I'm not saying it's everything, but there's something. There's something there. I think it's, maybe it's just a spurious correlation, and it's just the U.S. dollar is moving both of them. I don't know. Foreign reserves tend to be deep and balanced. Selling may be limited to T-bills and bonds close to maturity in their holdings. Recent sell-off on the long end of the curve. Losses could be huge if foreign reserves choose to downsize their long bonds right at this moment. Yeah, true. I would think incremental increases in energy prices would create incremental pressure on the bond market. But can this much price be moved? Well, I'm not saying it's all, but there's something there. When we think about what's causing yields to rise so much, I don't think there's one thing going on. I think there's several, I wouldn't say many, but there are several things that are going on all at the same time. I think the selling pressure would be less if energy prices were going down and not up, or if the U.S. dollar were going down and not up. I think it would be different. What are your thoughts on Bill Ackman covering a short position? Yeah, he is playing. He's not playing the market when he does what he does. He's playing you. He's telling you he's shorting the treasury market because he wants a whole bunch of people to do the same thing. Then he's telling you he's covered his short on the treasury market and probably went long because he wants everybody else to do the same thing. So he's not only playing the market, but he's playing the audience by telling them. He's aware that people will listen and will copy him, so that's what he's doing. But I think it had something. I think it added something that, okay, well, this guy's done shorting the market, shorting treasury markets. Maybe yields have topped out here. Do you think it had an effect on sentiment? Yeah, I do. It's stopped downward momentum for a little bit. Thoughts on GM's earnings and forward guidance? The earnings were, I mean, if you controlled for what happened with the strike, they were good. I don't think you can argue with them. They pulled forward guidance, which makes a lot of sense because at this point they don't know. They don't know what their labor costs are going to be. So I would pull forward guidance, most definitely. Not only that, if you guide upwards, the union's just going to be dig in more, saying you think you're going to make even more, and you don't want to give us stuff. So, I don't know that they could have given guidance, and if I were in the room, I would have, and they said, well, here's our guidance. I would say, whoa, hang on. Let's maybe not say that right now. Couldn't we say something else? Now, we can't guide lower. We can't say, oh, we're going to do terrible to back the union off because there goes our stock price. Can't say we're going to do great for our stock price because, well, there goes the union. Let's just not say anything. So I think they had no choice in discontinuing guidance. And because they're still in negotiations, they're really not going to say much to upset the other side or push the other side into any, being angry or anything. They're going to be as diplomatic as they can. Seems a little tricky trade as long as UAW is breathing down their neck. It is. They printed high 28s today. I still think 25 is not unrealistic to see it trade down to. I think if we do get a recession, GM could see below 20. And even if they give the union what they want, and they do very well over the next 3 years, the union's going to be right back at it again. They destroyed the car companies in 2007, 2008. They're going to do it again. What you have is a company that has made two deals. It made a deal with labor by saying, hey, you give me an hour of your time and I'll give you this much money. And this person said, okay. And they made a deal with capital investors saying, you give us some equity and you'll rank below all of our liabilities. You'll rank below all of our bonds. You'll rank below preferred shares. You'll be down here on the capital structure at the very bottom. But, because of the risk you're going to get, you'll get the upside. Okay, so now what you have is this group of people saying, hey, these guys are doing really good. We want some of what they're getting, but this risk part, we don't want to do that. We just want to take some of their gains. Let them keep taking the risk over here, but give us some of their gains. Record profits, let's just word that right. Record earnings for people who take the riskiest part of the company should mean record labor. Why? Where was the risk? What risk did you take? What risk did you take? You made a deal. You're going to trade hours of your life for some dollars. These people are going to trade money for some dollars. That's the deal they made. Now you're looking at their plate saying they got a lot of food. They got a hell of a lot more food. Yes, I got the food that I agreed to, but I want some of their food now. I want some of theirs. Well, I think that the equity holders should look over at labor and say, well, hang on a second. We want some of this money that you're making per hour. We'll give you some of our stuff if you give us some of your stuff. But this is what unions do. And they look at these guys and they say, well, they're making more. We want more, but we don't want to risk more. And they make more. Well, we want more of their stuff, but we don't want to risk more. That is, I don't know that I would want to touch anything with the UAW in it anymore. I'm out. Let's see. I wonder how much copper goes into hybrids. More than internal combustion, but not as much as would be fully electric. Anytime you have electric, you have electrons, right? And electrons need to travel along something, and copper is the best for that. Ford Maverick has been sold out for 3 years running. EVs won't become mainstream until the charging infrastructure is there and charging times get down to less than 10 minutes. I think you're right. Until then, they will be commuter cars for wealthy people that have dedicated charge spots. I think you're right. I do think you're right. I think the path forward is hybrid. But car companies, have said, have many of them said, we don't want to be in the dual powertrain business, one or the other, but not both. We don't want to be in the dual powertrain business. So hydrogen is a possibility, or just you get so good at carbon capture that you make every barrel of oil neutral, and there you go. And I think you end up with a portfolio of solutions. You have electric for those who just drive to work and back, who barely drive and who can charge at home all the time and never have to worry about range anxiety. You have internal combustion for those who want internal combustion, and the cost of carbon capture is in the price of oil, so they are carbon neutral at that point. And maybe you have, good advances in hydrogen, and you can have that. I don't know why governments are so hell bent on there being only one option for consumers. I think, with everything that they're pushing, with all of the tax rebates and all of the tax credits, that you have inventory building on EVs, I think is a sign. I think it's a signal that the market is saying, maybe you've run out of the early adopters. Have you ever thought of starting your own hedge fund? No, I would not want to do that. Thoughts on agency? Already did that. First time buying a bond. When I see 10-year bond rate headlines in financial news, are they referring to newly issued 10-year treasury bond? They're referring to what a yield on a newly issued 10-year bond would be if it were issued that day. In other words, it's called a par yield, right? So the yield curve, whenever we talk about the yield curve, and you see, 10-year is 4.96. That is a par yield. That's for a par bond. In other words, if a 10-year bond were issued at that moment, for par, meaning you pay $1,000 for the bond today, and in 10 years we'll give you $1,000 back. When you do that, that means it's selling for par. It would have a coupon of 4.96%. So that's what the yield means. Or it could be a 30-year issued 20 years ago. A 30-year issued 20 years ago would be a 10-year bond and would yield 4.96, but not necessarily have a coupon of 4.96, which means it would not be trading at par. Bonds are quoted on a 100-point system, 100%. So when you see a bond price of 83.56, that doesn't mean it's $83.56. It means it's 83.56% of its future value or its face value. And bonds are a $1,000 increment, which means you're paying $835.60. So it may have a lower coupon, but the coupon, the cash yield you get is whatever the coupon rate is over the $835. And then the difference is, because you're buying at a discount and it's maturing to par, the rest of your yield is in the pull to par. So as time passes, this $835.60 will be pulled to the $1,000. It's mathematical. It'll be pulled there. So yeah, you could buy a 10-year bond, a 30-year bond issued 20 years ago, and a new 10-year bond today are 10-year bonds. And they should have very close to the same yields. I don't want to get into on the run versus off the run, but let's just say very close to the same yields. But that doesn't mean they'll have the same price or the same coupon. The price and the coupon is fixed, so the price adjusts such that the yield would be identical. In terms of EV demand decreasing, I'd say I agree on the most part. Ford, GM, Stellantis have not put in any mass market appealing products for consumers. I don't know. And the recent UAW strikes have provided them the perfect cover to delay their EV transition. In terms of Tesla, I don't think you could draw any meaningful conclusions from Q3 specifically. They already mentioned in Q2 call that the factory production would be reducing Q3 due to upgrades. It's not just this quarter. It has been the last 7 quarters that gross margins have been declining and declining and declining and declining. Growth rates have been declining and declining and declining. Average selling prices have been declining and declining and declining. It's not just this one quarter. And every quarter is always the same. Well, but they said this and they said that and it's this and but it's that. It's but. So I still think that this is a $50 to $60 stock masquerading as a $200 stock. It is a car company. It's not a technology company. It's not an energy company. It's not an AI company. It's a car company that's doing things. Okay, it's a car company that's doing things. So it is going to have a difficult time escaping the gravity of the economics of the auto industry. Period. And the last 7 quarters have proved that their operating margins, I think the 7.9 all-in operating margins, they're under 10%, are like 150 to 200 basis points above the industry average. A couple more quarters and they will have industry average margins, which means they should have an industry average multiple. You mentioned previous videos that your house is being refurbished. All done now, but as you're selling it right now, is the investment refurbished meaningful? The value of my house is I don't rely on it for retirement. If I were going to hold the house for the next 10 years, yeah, it was. But I can sell it for more than my all-in cost. I didn't see it as an investment. If I did see it as an investment, there were choices that I would not have made. I would not have gone with the more expensive fill between the paver stones. I did, because that sand, that sand you put in that hardens, that only works for 2 or 3 seasons, and then you got to do it again. I upgraded. I wouldn't have went for all of the upgrades, because you go for show, low cost but big show. If you're doing improvements, you do a coat of paint, but you use the cheaper paint. You don't use the expensive paint. You build the house for show. I certainly wouldn't have put in $2,000 toilets, right? But I did. Waterless tank toilets, they're all air. So when you hit that flush thing, it's gone. It's like an airline jet. It's just gone. Like, not even, you can't even count to 1 by the time it disappears. I wouldn't have done that. So I didn't remodel as an investment. I remodeled based on what I wanted to live in. And then I got the idea to get the hell out of the country. So which broker are you planning to switch to? JP Morgan for my external, and IBKR in Costa Rica. I had some agency puts. Okay, yeah, agency. Oh, hang on. This was about, given that this is Canadian non-reg margin account and the puts expire November 17th, should I close them out at a loss and roll into January 25 or 26 short puts for tax efficiency? Well, you can't, right? You can't do it for tax efficiency. That's not a loss, because you are moving into the very same security. So it wouldn't matter. You couldn't use that loss as a tax loss this year, because you're basically taking a loss and then re-entering the very same security. So that doesn't work. I would hold them normally, but cap gains versus U.S. REIT dividend taxation seems more favorable. I don't know. Not enough information here for me. Any comment on gold? Nope. No, I'm not a gold person. I'm not a Bitcoin person. Crypto at all. None of that. If the institutional funds are going along into the curve, would it not reduce the interest rate? Well, it depends. Is there more coming out than what's going in? Took DRH 12 years to get back to its 06 peak. DR Horton, DRI. I think you mean DR Horton. Might have to stay in that coma longer than expected. Well, the 06 had an oversupply. You had overbuilding of houses. So you had a massive oversupply. So you had to wait for that supply to be worked off. Right now we have a deficit. As big as there was a supply, now there is a deficit. So I don't know that it would take that long to get back to its peak again. Agency. Yeah. Uranium? No, I haven't looked at uranium lately. I think this has been asked a couple of times, and maybe the question writer's not watching the video. But no, I don't know anything about uranium. Cash on the sidelines, 10K or so, face value, the 25-year long bond. How can you get that done with an IB account? Treasury Direct? Well, no, Treasury Direct is for the issuance of new bonds. All you have to do is analytical tools, bond scanner, and then right at the very top, there's 4 little radio buttons. Select the one that says U.S. Treasuries. Select the range in years that you want. Hit search, and it'll return the bonds, and then you pick the one you want. Jamie Dimon, Fed funds rate potentially rising to 7%. I don't think they're going to 7. Mentioned that this is one of the most dangerous times the world has faced in decades. Sounds pretty fatalistic and gloomy to me. In decades? I don't know if I'd say in decades, but at any given time, the world is a dangerous place because the world is populated by humans that all suffer from the human condition. And we have social structures meant to minimize the effect of the human condition, but you can't legislate away the human condition. It will show up, and that's what makes the world such a dangerous place. Do you think there's any truth to his statements? I've said that before, that it's just, because of the human condition, you need strong structures. If you didn't have strong structures, it would be a brutally difficult place, a planet to live on with all those humans. And I've said it this way. Let's assume for a moment that the structures of society have broken down. There is no rule of law. There's no government. It's like Walking Dead, where you have a group of people that you hang out with, and you stay with them for protection. It would be like that. Would you trust a single stranger walking up your driveway? And almost everybody I asked says no way. So you see, that's the human condition. They understand it. No way would I trust a single person walking up my driveway, not without the strong structures of society. It's when structures break down, it's when strong structures break down that you get rises in crime, because the human condition shows up. You get rising rates of crime, rising rates of hate, rising rates of war and terror and all of those things. So there is a case to be made for dictatorships because you need strong structures to protect yourself from that human condition. But at any given time, the world is a dangerous place. Look, there are some neighborhoods in the U.S. I would not advise you to walk into at all. Not one bit. They are dangerous, dangerous places. Some of them more dangerous than war zones. So you don't have to go far to find danger. Interested in hearing your views on fiscal spending and its impact on the economy. Do you believe it has the potential to stave off economic slowdown, potentially drive up interest rates? Stave off an economic slowdown, potentially drive up rates. Fiscal spending. So my view on fiscal spending is that it is not something you have to advocate for. Fiscal spending is like a river out of control, right? The question is not will water flow, it's how the hell do we stop this, because it is overflowing the banks and flooding right now. It's causing more damage than not. And to do that, you need better people on both sides. To do that, you need better voters on both sides. Not going to happen. Not going to happen. I think history will look back at this time and say, this is when the beginning of the end happened for the primary economy on the planet. Unless there is some change in the way that governments operate, I don't know that these countries have a future that's going to be better than other countries. I would even bet at this point in time that unless the U.S. changes its direction on its spending, unless it changes its direction, by 2050 it'll probably be the third largest economy on the planet. Not the first, but the third largest. And by 2100, maybe is still in the top 10. It has to change its ways. We spend money on absolutely ridiculous things, and it all has to be paid back. Isn't Global Foundries more of a close second to TSMC? No, God, no, not even close. Global Foundries is U.S. based. In terms of revenues, they're about 1/8 of Taiwan Semiconductor. Less than $2 billion in the quarter versus $17.5 billion for Taiwan Semiconductor. In terms of net income, Taiwan Semiconductor is 13 times more profitable with net income margin around 36%, with Global Foundries more around 12%. No, Global Foundries is not a close second. No. What do you think about the 2050 125 coupon? I think it's a 2050 125 coupon. I don't know what that means. What do I think about it? I need a more. What do I think about it in terms of what? So I don't know what to say about that. Every time someone says balance sheet runoff, or any comments about Fed either increasing the size or decreasing the size of the balance sheet, it completely confuses me and I don't seem to connect the dots. It just means that, let's assume that I had $100,000 in bonds and 10,000 were maturing this month, and I get my $10,000 back. It means that I'm just not replacing that $10,000 with new bonds. Now I have $90,000 in bonds. In other words, I'm letting the bonds run off. I'm not replacing them. That's what it means. Let's see. What are the monetary implications of doing so? It just means that when the Fed, the Treasury is issuing more bonds, the Fed is letting $65 billion a month run off. The Treasury has to find somebody else to pick up that $65 billion because the Fed will not replace that $65 billion. So somebody else has to come in and pick up the slack. You mentioned you're switching new broker. Does that mean leaving IB? Well, I can't keep IB Canada. When I was in the US, I had IB US. When I moved to Canada, you have to close your IB US and reopen and open IB Canada. When I leave Canada, I have to close IB Canada and open IB Costa Rica. Let's see. Where to hide for now? Cash. Cash pays. Cash is not trash. At 5.5, 5.6%, cash is not trash at all. And if you want to go a little bit further than that, you can go into commercial paper and grab maybe another 60 basis points on top of that, 6.1, 6.2. If you want to be in very high-rated money market securities by grabbing commercial paper. So cash is not trash right now. Anyways, that will take us through it.